Getting returns from an investment is an amazing feeling, but in order to get the best returns, you need to invest wisely. Here are 5 steps to find the best company to invest in. Future plans for profitability. Well, before we dive into what you can and cannot do to ensure that you're investing in companies that yield massive results, the first thing you need to do is invest in your own wallet. You know all those receipts in your wallet that you forget to throw out? Well, this is where those receipts will actually come in handy. Make sure you go through all the receipts and see what companies are you buying from constantly. This will probably help you identify brands that are actually pretty successful or are climbing their way to becoming big brands. For instance, you know the McDonald's or Starbucks receipts that have been lying in your wallet for a long time? Well, there's a slight chance that investing in these companies might actually help you make big bucks. Once you have shortlisted a few companies from the receipts that you have or the companies that you think people prefer to buy from, the next thing you need to do is check the profitability of the company. Is the company even worth investing in? In order to answer this question, you need to do a little bit of research and see if the company is currently making any profit or not. In case the company is not making profits recently, then you need to explore the future profitability plans that the company has. If your analytical skills tell you that the company's future plans will yield massive benefits, then you should definitely consider investing in that company. Well, before we get into more details about other steps you can take to find companies that you can invest in if you want to make the most out of your money, if you're liking our content so far, make sure to give this video a thumbs up. If you want to stay updated with news about your favorite celebrities, make sure you subscribe to our channel and turn on the notification button so you can get notified every time we post a new video. Index funds. Investing in company stocks is always risky, and there's a high chance that you might end up not multiplying your money. However, there are always things that you can do to mitigate the risk and to make sure that even if their company is going downhill, the financial impact is not massive on your pocket. One way to do this is to diversify your portfolio, thus minimizing the impact of just one stock on your portfolio. However, buying thousands of stocks of different companies will take you forever and will probably cost you a lot more than what you will end up making in a short while. So, what do you do then? Well, in order to navigate through this hurdle, index funds were introduced. These index funds have holdings of thousands of companies and will probably cost you less than $100. Once you buy an index fund, you can keep on investing in it, and once you decide to finally sell your index fund, there's a very high probability that you will end up making a lot more money than what you started out with. Long-term value investing and quantity analysis. When it comes to investing your money, the idea of investing your money somewhere and making a ton of money in return can be pretty exciting, and it's possible for anyone to make money as long as you set a long-term goal for yourself. Instead of running after companies that might have hit their peak out of nowhere or are involved in shady practices but yield great returns, make sure you invest your money with a long-term strategy in mind. But how do you decide which company is the right company to invest in? Well, before investing in a company, obviously you will check what the stock price is for that company. However, this is not all that you need to do. Even if you observe the trends in the company's stock prices, you still don't have sufficient information to make a decision. Once you've figured out the company you want to invest in, this is where the quantitative analysis comes in. You will have to put your financial skills to test and browse through the financial documents of the company, including their income statements, cash flow statements, balance sheet, debt-to-equity ratio of the company, and other financial KPIs to determine the real value of the company. If the figures that you find seem profitable for you, then you can risk investing your money in that company. Ideal size of business. When investing in a company, you need to look at the size of the company before making the final call about whether or not you should invest in it. One thing that is very important to look at is the size of the top 13% sales. This figure should be anything between $5 to $30 million at least. Another key thing to look at when determining the size of the company is to see how many employees the company has hired. Instead of going for a company that has thousands of employees, it's better to invest in a company that has 5 to 100 employees, since it shows that every person is taking ownership of the company, and there must be people involved who are aware of whatever is going on in the company. Regardless of whatever analysis you do, investing your money in anything always has some risks, and your main goal should be to minimize the risks while opting for maximum profits.